Picture this. Your husband of 41 years has died. The funeral has ended. The neighbors have stopped dropping off meals. And now you're seated at the kitchen table, by yourself, facing a mountain of documents you can't make sense of. Taxes are the last thing on your mind. And why would they be? You're mourning. But somewhere, silently, a clock has already begun counting down. 9 months. And hardly anyone warns the widow that it's running. If that clock expires, you could forfeit a safeguard worth tens of thousands of dollars, possibly much more. And here's the most heartbreaking part. You might not discover it until it's far too late to repair. I'm not saying that to scare you. I'm saying it because you have a right to know. And today, I'm going to guide you through each step. I am Edward. I'm a senior policy analyst, and for years my work has been straightforward. Take the bewildering rules that touch retirees and widows and break them down in plain English. So let me put your mind at ease right away. This is not a new tax. This is not a scam. This is not the government trying to seize your house. This is one IRS form and one deadline that most families simply have no idea exists. Today, I'll show you precisely what it is, who it affects, and the steps to safeguard yourself. And please, stay with me right through to the very end. Because there's one frequent mistake, a quiet assumption that feels entirely reasonable, that causes widows to lose this safeguard forever. I'll reveal that mistake and how to steer clear of it. Let me tell you about Robert and Margaret. Robert was 71, Margaret 68. They'd been married for most of their lives, 2 kids, 4 grandkids, and a modest home they'd paid off long ago, the home where they raised their entire family. Now, Robert and Margaret were cautious people. They paid their bills promptly. They never owed the IRS a single penny. They believed they had everything squared away. Then Robert passed away. Margaret did what most grieving spouses do. She managed the death certificate. She informed Social Security. She settled the final bills. And because their estate was nowhere close to the millions of dollars that owe federal estate tax, someone told her, "Don't worry, you don't need to file anything with the IRS." That sounded correct. It felt correct. So Margaret didn't file. 9 months passed, then 15. The window to file one particular form, the form that would have secured Robert's unused tax exemption and passed it to Margaret, shut. Now, in Margaret's situation, her estate was small enough that there's a fallback option. But here's the trap. Robert's safeguard wasn't automatic. It had to be claimed. And the family that says, "We don't owe anything, so we don't need to file," is precisely the family that strolls right past it. That small, reasonable assumption, "we don't need to file," is the costliest mistake a widow can make. Let me show you exactly what the rule truly says. Let's begin with the form at the heart of all this. It's called IRS Form 706. Form 706 is the federal estate tax return. Now, the name alarms people because most families never owe estate tax, and that's true. The exemption is massive. In 2026, each person can pass along up to $15 million before any federal estate tax kicks in. So you might think, "Edward, my estate isn't $15 million. This has nothing to do with me." But here's the part that almost no one spells out. There's something called portability. When one spouse dies, they typically don't exhaust their entire exemption. Portability lets the surviving spouse take the late spouse's unused exemption and combine it with their own. For a married couple, that can mean shielding up to $30 million from estate tax somewhere down the road. But, and this is the entire point of today's video, that transfer is not automatic. To claim it, the estate must file Form 706, and here is the 9-month clock. The IRS states Form 706 must be filed within 9 months of the date of death. You can request a 6-month extension using Form 4768, which grants you up to 15 months in total. Now, I want to be completely honest with you because honesty is the entire reason you should trust this channel. This 9-month rule is not new. It has been the law for years. The headlines that label it a secret new 2026 clock are overstating things. What is true is that this deadline is real, it's strict, and most widows have never heard of it. That's the genuine story. Now here's some good news, and I never want to leave you with nothing but fear. If your estate is below the filing threshold, which describes the overwhelming majority of families, and you miss the 9-month window, the IRS offers a second chance. Under a rule called Revenue Procedure 2022-32, you can still file Form 706 to claim portability for up to 5 years after the death with no special fee. You simply write a specific sentence on the return noting you're filing under that procedure. So if you're a widow watching this and your husband died 2 or 3 years ago and no one ever filed, you may still have time. That's exactly why I wanted you to see this today. Now let's talk about your home directly, because the title of this video mentioned your home, and there is a separate clock you need to be aware of. This one is not 9 months. This is a 2-year clock, and it concerns capital gains tax if you ever sell the house. Here's how it operates. Normally, a single person can exclude up to $250,000 of profit when they sell their main home. A married couple can exclude $500,000. When your spouse dies, the IRS provides you a window. If you sell your main home within 2 years of your spouse's death and you haven't remarried, you can still claim the full $500,000 exclusion. But once that 2-year window closes, your exclusion falls to $250,000. That difference could translate into a real tax bill on the sale. And one more bit of comfort. There's something called a step-up in basis. When you inherit the home, its value for tax purposes resets to whatever it was worth on the day your spouse died. So frequently, there's little or no taxable gain at all if you sell soon afterward. Please don't panic sell out of fear of a tax that may not even exist. Slow down and gather the facts. So now you grasp both clocks. 9 months for the Form 706 portability filing, 2 years for the home sale exclusion, 2 completely separate rules, and people mix them up all the time. So what do you actually do? Let me give you 3 clear steps. Step 1. Don't assume you don't need to file. This is the trap that ensnared Margaret. Even if your estate is small, even if you owe no tax, ask specifically about filing Form 706 to elect portability. The safeguard only exists if someone claims it. Place a note in your calendar within the first month after a spouse dies, so the 9-month deadline doesn't catch you off guard. Step 2. Speak with a qualified professional before you make big moves. I am not your tax advisor, and this video is general information, not personal advice. Before you sell the house, before you file or skip any form, sit down with a licensed CPA, an enrolled agent, or an estate attorney. Ask them 2 direct questions. Should we file Form 706 for portability? And what is my deadline to sell the home for the full exclusion? A good professional will understand exactly what you mean. Step 3. Keep every document and verify everything at the source. Keep the death certificate, the will, the home purchase records, and any appraisals in one secure folder. And when you read an alarming headline about a deadline, head straight to the real source, IRS.gov. The genuine information is free, it's public, and it's right there. You never have to pay a stranger to tell you what the IRS already tells you for free. Now, before you go, one honest word from me to you. There are plenty of people online right now who use words like urgent and secret deadline to frighten seniors and then push you off to a private message channel or ask you to download something or hand over your personal information. Please be cautious. Real government deadlines are never a secret, and the real information is always free on the official sites IRS.gov, SSA.gov, Medicare.gov. So here's my call to action, and it's a simple one. If this helped you, subscribe so these explanations reach you when you need them. Share this video with a friend who has lost a spouse. You might rescue them from Margaret's mistake. And leave a comment below if you have a question. I read them, and your question may become the next video that helps someone else. And whatever you do, when it comes to your money, your home, and your family's future, verify it at the source and rely on a trusted, licensed professional. You've worked your entire life for what you have. You deserve to protect it with clear, honest facts. I'm Edward. Thank you for spending this time with me. Take care of yourself, and I'll see you in the next one.